Welcome to Top Stock Picks, an adjunct to turning hard times into good times. Well, as always, I like to have Michael Oliver on with us every week and to give us an update on some of the key markets that I follow in my newsletter as well as on this radio show. Michael follows many markets beyond those that we look at and really to take full advantage not only the markets we look at, but in more detail, as well as many other markets we don't have time to talk about here. I would suggest you strongly consider subscribing to Michael's excellent newsletter, and to learn more about how to do that, go to olivermsa.com, olivermsa.com. Thanks for joining me again, Michael.
Great to be here, Jay.
Michael, in your weekly missive that you send out, which is a must-read for me, I must say, you talked a lot about silver and gold, but you also think that a really big deal now is the dollar. Talk to us about the dollar and what implications that might have for some of these other markets that we look at.
Well, for those in gold and silver, the last year or so, since February last year when it broke out, silver and gold broke out, and then GDX broke out, and they surged. And it was a nice move, and they didn't need any help from the dollar. Mm-hmm. And they've pulled back, but they're still holding nice gains, and versus that entry point in the low 1100s on gold. But I think now we're at a point where the dollar does have to get off the fence here. Mm-hmm. And it's been on the fence, so is the euro. They've been stuck in a 7-8% range for 2 years. There's almost nothing going on. Minor moves look big now, but it's really nothing. It's a nothing market. Mm-hmm. There's no trend in it. But there's major trend factors underneath the dollar on annual momentum of the dollar. Forget the price charts, the momentum oscillator. And late last year, we put out a number that we thought would be major for the dollar index this year, and it was 99. Mm-hmm. The dollar closed out last year at 102.23 cash dollar index. It made a marginal new high early in the year, 103 plus, and it turned around and collapsed to 99.23. Stopped 23 100s in front of our number. Hot-footed it back up on the year, got up above 102 again. This is late February, early March.
Right.
Then rolled over again, came back down, broke through 99 for all of 2 hours. Traded 98.85. Wouldn't close the day below 99, and now you're back up near 101. So our number turned out to be very accurate. We wanted a monthly close at or below 99. Mm-hmm. And we've traded just in front of it, we've traded just below it, and the market explodes up off of it every time. Now, in an early bull market, if you find a support level, you might play it and say, okay, this is a good place to buy. But this is an ancient 10-year oscillator, it's longer than that. It's 13 years of oscillator uptrend from the 2004 momentum low. It is now hugging the momentum structure. It's like a guy on a beam. He's just hanging onto it, afraid to fall off. You see that? Okay, and it knows where the number is. So we pick the number, and I'll be darned, the market knows it. Mm-hmm. The euro is the same thing. Now, what's going on, I think, is that they're playing this European fear game of, my God, if Le Pen wins, the euro is going down. And every time there's a terror attack, that helps boost Marine Le Pen's poll ratings.
Sure.
And, whether she's going to win or not is highly debatable, especially in a second runoff. But think about this for a moment. All of these euro-related fears, for instance, the Brexit, the initial response was to panic and sell, and then what happened? Yeah. Everything went back up. Okay, it was late June last year. Mm-hmm. So a major low in most markets that were fearful after the Brexit vote. Then when Trump won, there was a rapid sell-off in all the markets that have since gone up.
Absolutely.
So what happens if Le Pen wins and they sell the euro off is yet another false downside spike in the euro, upside the dollar, and we reverse, I don't know. But all I know is the dollar is sitting on a major fence. Our numbers, we're very confident. We're more confident now because the dollar's behavior has told us that is, in fact, the number. Therefore, I have a feeling, it's a sense, it's not scientific, that gold and silver aren't going to engage in the next surge yet until that dollar makes up its mind. Mm-hmm. And our view is it's going to happen. There's too many negative technical attributes out there. Whether the dollar can spike once more on the upside, we think if it happens, it will be brief, or it simply won't. But I think now for gold and silver, folks, they should be looking more at the dollar than they look at gold and silver.
Oh, very good. Very good advice. But, just looking at your charts again for gold and silver, Michael, it seems as though if I just looked at a price chart, I would think that both of those metals are more challenged than if I look at your momentum charts. Your momentum charts show support, whereas the price charts seem to be, having a hard time breaking out to the upside. The momentum charts show that they're considerably above support and not that far away from breaking out, perhaps.
No, I'm talking a second restart of the motor, because the motor started. We've already moved off the lows. I mean, you've seen the bear market lows. We're in the bull market. But there's still a struggle phase here. And that's not unusual. We've seen in most markets when you don't just go from A to Z in one shot. There's counter trend moves that cause the people who are on the right side to doubt their sanity.
Sure.
Well, and ultimately, they find out they're right, but you have to weather those periods. I think we're in one of those. But I think the dollar is a key factor now.
All right. Well, a couple of other big markets I'd like to ask you about. The T-bond market, of course, that's a biggie as well. What are you seeing with that now?
We're bearish major on T-bonds, meaning the yields are going up. But we got bearish at 166 on the T-bond futures, and they dropped to 148 almost in December. By December, in 3 months, they dropped from 166 to 148. They rallied, and they went into a trading range, a very narrow range from about 153 to 148. And then last month, they went down, nipped out the low, got down close to 147, but it didn't take. They hooked right back up. Right now, we're 151.5. We still think there's a counter-trend rally, probably sharp, probably related to weakness in the stock market. And it just looks like it's inevitable to happen. It is not for real. It is a trading rally. It is against the major, fresh, new bear market trend in T-bonds. But it is something that needs to happen. We happen to think we're going to go at least to 156, which is to say about a 8 or 9 point rally off of the recent low before you exhaust the rally. But so far, we can't seem to engage it. It sits there poised as if it's going to spark that rally. I think it's looking over its shoulder at the stock market. Stock market is constipated, so are the bonds. And I think our bias is you're probably going to pop the bonds, and it'll be coincident with an S&P sell-off. Nothing drastic in the S&P, just enough to spook people into buying bonds, and as they're selling their S&P. And ultimately, though, I think higher rates are coming, and I think at that point, once that fear factor goes from, right now it's comfort level. Investors are comfortable with the slightly higher rates. They think it means a good economy.
Yeah.
Okay. But once it gets a bit beyond the beyond, I think that will shift from investor comfort to investor fear, that rates, in fact, are going to get higher than they thought. And that's when we could have a marriage of T-bond direction with stock correction, both down.
So Michael, we could see rates going up at the same time and the dollar declines, huh?
Oh, yes, because everything's relative. You got to remember, our rates could go up, but the question is, competitively speaking, which is likely to go up more? The European rates have been pushed to zero. Which is the beach ball that's been more submerged?
Yes, of course.
Our beach ball or Italian yields down around 1%, which is ludicrous. I mean, So when they get unleashed and rates start to rise, then it becomes an issue. Yeah, our rates rise. That would normally translate to a strong dollar. But what if their rates rise more? Okay, so that would help the euro. Okay, so that's the way we see that.
All right.
But anyway.
Okay. Well, then one more market that I want to ask you about is crude oil. You've of course, crude oil was one of the leaders in what you've pronounced a new bull market in commodities. It's had some weakness, but I guess you're thinking it could be ready for some more strength soon?
Well, we had expected, we hit a high early this year of 55 and change. And at that point, we expected, we got out of we urged people to exit longs that we had urged them to get into around $42 last April. We suggested in the mid-50s out. We're looking for a correction. I thought we could get to the low 40s. Instead, the lowest it got just about 47. So it dropped $8 off of its yearly high, got to 47, about halfway to where we thought it would go, and it's now back up pushing 53 again. Now, the 3-year average of oil, which happens to be structurally important on momentum, is 53.48. We closed slightly above it in February, but it should have been resistance, and it was, and we dropped $8, but we're now back up there again. And when I see that kind of behavior where you've got a key resistance point on momentum, hit and then backed off, fine. Going back there again shows intent to possibly overcome the resistance and continue the upside. Now, if that occurs, then the lull we've had in the Bloomberg Commodity Index, for example, the broad basket, will be arrested as well, and it'll turn up. And I'm also watching grains very intently, because if grains join in, which we expect them to do probably in the first half of the year, that will be a chorus in the commodity markets.
Mm. Well, I guess if you were to sort of summarize your views on the markets, then, Michael, we're looking at a bullish point of view in the commodities, precious metals, of course, and the currencies, bearish in the equity markets eventually, and the debt markets, eh?
Right, and we had a warning, though, about the S&P in our weekend report. We looked at some major indexes, including the NASDAQ 100, which is, of course, been a leading index. It's a broad index, but it carries a lot of healthcare, biotech, and tech stocks, which have been leading, Googles, the Amazons, and so forth. It looks to us that if you can easily top the market this year, you can easily get some decline between now and the end of the year, possibly substantial. But to get a bear market underway fully, to really pay your dues, does not look like an event for 2017.
Oh.
It looks more likely that 17, while it could be weak, is more likely to be a fighting downside move, not a straight and easy move. Remember 2008 bear market. Started with a 200-point drop in January. By May, you were back up unchanged on the year. It wasn't until late 2008 that the bear market unleashed itself. So protracted.
Yeah, so not an easy market to make money on the short side.
It might be a place to be short S&P, but long, strong sectors, such as the material sector is one. I think the energy stocks, if oil gets back over the 53.5 level on a monthly close, the XLE might be a place to be long, while simultaneously short S&P. So spread position would be what we think is probably the better place to be this year, as opposed to outright short the S&P.
All right. Well, very good advice. And, of course, those are the kind of trading details that you provide for your paid subscribers that sign up for your letter at olivermsa.com. olivermsa.com. Thank you so much for being with us again, Michael, and I hope we can talk to you again next week.
And thank you, Jim.